So after the video I posted yesterday, I had about a dozen DMs on LinkedIn essentially asking why I didn't invest in a company that I was confident or had better than even odds, in my opinion, of returning an investment. In fact, it was around 3x. And this was the company Plum. This is now a good example of how different investors have appetite for different types of risk, but also how different investors have different funds with different risk profiles. So for me, for example, I invest in three ways. I have my personal kind of major investments, and this is where I pick a startup and a founder that I really align with, I feel I can add some value to. I strongly believe in the future of its technology and the macroeconomic trends, and I believe I'm some, moderately well-informed human about. And those types of investments, I have my own personal fund, which I invest anywhere between 10K and 25K per investment. My second is I represent as a venture kind of partner other people's VC money. And sometimes these are family offices, sometimes these are venture capital funds. I will go find deals that meet their criteria, and then I get essentially a bonus if those companies end up being successful. And that bonus is called a carry. So it's not my money necessarily, but it is my investment. And for that, the investment's anywhere from 100K to 2 million, just depends on the opportunity. And I need to vet and do diligence on that deal in a pretty aggressive manner, in a way that fits the checklist of those funds. And then my last kind of bucket of money is kind of my fuck around money, so to speak. This is what I'm now using. It's around £30,000 I've set aside for this year to see if I can invest in 100 crowdfunding companies. And I'm anticipating to put in about I'm expecting to make 30 investments. That's kind of what I planned. Now, in that fund, my thesis is very different to the thesis to my big personal investments. And then that's very different to the venture capital thesis, which requires their investment thesis to be the one I follow. Now, in my crowdfunding investment, all I'm really looking for is to see if one investment can repay the whole fund. Is it possible to do that with crowdfunding? Because if it is, then crowdfunding isn't just a fun way to engage with a startup and be on a cap table and maybe get a return. It could also be a way for a VC to meaningfully participate in a different investment economy. But the only way that will work is if I follow the VC rule, which is one investment must be able to repay all of the fund. So even though in this pot of money which I'm investing from, there is an opportunity to get my one investment back, maybe 3x back, it's not going to return the fund. It's not going to meaningfully, add more value so I can go in and make more and more and more and more investments. And so as such, it couldn't be a professional fund. So I'm trying to see if crowdfunding can be a professional fund and not listen to all the fucking bullshit which comes out from Seeders and Crowdcube, which I know is riddled with kind of very cherry-picked statistics which don't really tell the full truth. I want to find out for myself. So that's why I didn't invest, because it came from a pot of money that had a different thesis to my others. Now, my bigger checks, and don't get me wrong, they're not big. My bigger checks, I probably would have considered investing, but because I'm not an expert in the subject, it just wasn't a fit for me. Hope that makes sense.